you. Obviously, the muscle memory for October is not good. It goes back years.
Many years, crashes, massacres, all sorts of sell-offs.
Is it justified?
I think so. I mean, it sits at a very critical point in the calendar. We have the fiscal year for the mutual funds on October 31st. You've got the beginning of the fourth quarter. There's a bit of a self-fulfilling prophecy. That's what we call it, October-phobia, but it tends to be a bear killer. It's improved. October's improved over the years, but pre-election years like we have right now, it's actually second worst. So our outlook, what we're looking for is a little more weakness and volatility. I mean, that's what we get in October, and we're getting it. So it's not as much of a surprise, and we've been prepared for it.
Right. When you look back just 1 year ago, you also think back to the time when just before earnings season, things started to crumble a little bit, and then we went into a 20% decline towards the end of the year, which is highly unusual because of the seasonality factor.
Especially fourth quarter of a midterm year, usually a lot better than that.
Okay, so...
But we had the Fed
Is that a reason for it to not happen again this year?
That, and I think it's a different situation. We had the Fed being quite hawkish. Now the Fed's been ahead of everything. That we've seen the slowing growth, even with the ISM non-manufacturing a little bit weaker, but still expanding. Fed's been on top of that, and technically we've got some similar issues, but we've held up better this year. I know Steve's got a couple things on that. I'm looking for a level of about 28.15, which we held back in August. Below that, this is S&P. Below that, 27.25, where we held in June. It seems to be a little more critical support level for me.
Steve, 28.15?
That's right around there. So if you look at the chart, 28 and 22 is the level that we held right here, depending on even looking at the cash of the futures. So I'll agree with Jeff's level. That's close enough. And if you look at where we're at now, we've had a little bit of a rising, a little bit of a higher low situation that we've been dealt with in the marketplace. But here's the problem. If you look at this level, this was, a disaster basically right there. That's the one that you really want to keep an eye on. The main problem, though, Melissa, is that right here you want to be above that 29.25 level or 29.50 level. Of course, that's better for the markets to feel a little bit better about themselves and be less jittery going forward with all the stuff that Jeff already laid out. The odds of having the same October, November, December seems slim in my mind, but the market is still worried about a redo of what we just saw.
What do you make of today's bounce, Steve, particularly when you take a look at the outperformance of the NASDAQ, and within the NASDAQ, within technology, you're seeing, for instance, semiconductors do extremely well. A lot of the recent IPOs that have just been battered are bouncing today.
So that is all, to me, you got that terrible number coming off of the worries that we've seen in the last couple of days. That leads you to believe that it's about a Fed rescue. And you saw the odds of a December cut. Everything is in the cards for October. It's all but in the cards for October. But December is what we're looking at, that the odds went from a 30 to a 60% chance of a cut. And that's why the markets rallied. And that's why technology took the lead.
Jeff, as we look towards 2020, the election looms very large. And I know you said there's some election patterns that obviously they don't play out every time.
No.
But what is the window for the president if he wants, off the top of the show, Steve talked about these numbers, how even Republicans are losing their optimism about the economy. Absolutely. What is the president's window to change that in order for it to have
You mean do a trade deal with China?
Whatever it's going to take. I mean, just announce one,
I think it depends upon how much pain he's willing to feel in the economy and the market. So far, it hasn't been that much. I think we've got a little more pain left here in October, seasonally, technically, fundamentally, setting up. I suspect he'll get a deal done before we really start the campaigning, somewhere between now and the spring, maybe even sooner than that.
When do we, I guess my point is historically, timing-wise, these candidates are very candid.
It usually happens in the pre-election year. That's when they start to prime the pump. That's why the pre-election year is the strongest.
Of this year, would
I mean, if you were to follow the cycle with pre-election being the strongest because of the pump priming, you would see that happen before the end of the year and that's why we have that rally. Most of these highs in pre-election years are in December. A lot of them are even close to year end, and that would. Looking historically, I would suspect that we'd try to get it done before the end. Next year is also more bullish to have when you have a sitting president running for re-election than people would imagine. 10.1% versus about 5% for all, and minus 1.6% when you have an open field.
To the extent that any historical norms apply here.
Correct. I mean, we're seeing it track out pretty closely in the seasonal patterns this year, historical norms.
Fair enough.